panel consists of Devin Huber, principal and founding team member of the BSC group. And thankfully on the ad that run immediately before now, Devin, that you had some professional models acting as bankers. We appreciate that. Aaron.Swerdlin, vice chairman of Newmark, the premier self-storage portfolio brokerage firm with a niche of institutional quality portfolios. Anna Taylor, vice president of self-storage lending at Live Oak Bank. And Liz RAUN.Schlesinger, founder and CEO of Merritt Hill Capital, which is an active private participant in the growth of our industry via acquisition. So with that, I would like to start with Anna, who is our banker here and does direct lending, and hear from you, Anna, exactly which product offerings are you seeing get the most demand in today's market, which requires aggressive financing in order to support prices being paid for self-storage facilities? What are people most interested in that Live Oak has to offer?
I think people are most interested in construction financing with Live Oak. They're seeing the challenges of getting through not only construction and lease up, and are attracted to the extended interest only and working capital that we can provide with construction financing. So I would say the majority of what we're doing within construction space is under the SBA umbrella, and specifically the SBA 7(a) loan.
Mm-hmm. And tell us a little bit about the SBA, the structure of the SBA loans. What does that look like from a borrower's perspective?
So I would say that the biggest takeaway from a borrower's perspective is that's a higher leverage loan option. So, traditionally you're putting, 25% down as the equity injection. And with SBA, it's a higher leverage option for small business owner operators. And so typically they're putting 10 to 15% down as their equity into the project, both for acquisitions and new construction.
And is it a highly bureaucratic product because it's a government-sponsored program, or is it manageable from the borrower's perspective?
I think that depends. I think it depends on which bank you go with. There are a lot of banks that can do SBA loans, but I would say not a lot of them do them well. Live Oak is the largest SBA lender by dollar volume in the country. So we have delegated authority from the SBA to approve and close our loans in-house. SBA loans are still going to be a little bit more paperwork than traditional loans, but I think if you deal with a lender that's really experienced with the product, the borrower's experience is going to be a lot better, and the process will seem a lot smoother. If you're dealing with someone who doesn't think they can get it approved conventionally and tries to squeeze it into the SBA box, but they don't have experience with the loan program, I think from the borrower's perspective, it can feel clunky and paper intensive. So it's really important to partner with a lender that knows what they're doing.
That sounds like solid advice. So Devin, you are not a bank, but rather a financing broker able to offer many lending products. In today's go-go environment, what loan products are you seeing your customers gravitate to on the acquisition side and on the development side?
Well, thanks, David. I appreciate that. We are extremely busy right now. I think, like everyone in our industry, there are just a plethora of lenders, trying to get into the space and provide, capital to self-storage owners. And there are a lot of self-storage owners out there taking advantage of these low rates. So to answer your question, it really is a function of where the asset is in its life cycle. So on acquisitions, if the property is stabilized, we're really seeing, one of two avenues, either, long-term fixed rate debt, which is being provided by CMBS lenders and insurance company lenders. Those deals are being underwritten to extremely low LTVs right now. And that's simply a function of where cap rates are in this market. Cap rates have compressed compressed to such a low level that it's very difficult acquisition debt on a stabilized asset. So we're seeing most acquisitions, the LTVs coming in at 55, 60, maybe 65%. And again, that's because they're being constrained by debt yields, and both insurance companies and CMBS lenders use debt yields. The good news is because those leverage points are so low, the rates are extremely low as well. So interest rates, for those permanent deals are anywhere on the low leverage side of, 2.75% all the way up to 325 to 350. So really, really low interest rates. And most of those deals, because the leverage is so low, come with 10 years interest only. If you've got a stabilized asset and you need to push leverage a little bit, local banks and regional banks are offering a little more leverage, and that's because they don't constrain their loans by debt yield. They're more interested in debt service coverage ratios. And because interest rates are so low, debt service coverage ratios, are coming in. So you can get a little more leverage if you're looking at, local and regional banks. However, there's a trade-off, and that trade-off is those loans typically come with recourse. If the asset you're acquiring is not stabilized and there's some upside in it, you've got a lot of options that allow you to get higher leverage. If you can prove a roadmap to the lift in NOI, you can borrow from private debt funds, from some insurance companies, from bridge lenders. You can borrow 65, 70, and even close to 75% of the acquisition price, assuming that there is quantifiable upside in those in that NOI. And so deals that are being purchased at C of O or some point during their lease up, we're able to get that type of financing for them. You mentioned construction financing, David. That's always been, and I think continues to be, a local and regional bank market. Most of the deals that we're seeing getting done are getting done by local and regional banks as well as the SBA. There are some private debt funds and insurance companies that have entered that space, but that comes with some unique characteristics. So if you're in a major with high with a trophy asset or a trophy development, you're going to get some interest from insurance companies at lower leverage. We're talking 55, 60%, and it's going to be non-recourse. On the flip side, there are some debt funds who are offering higher leverage construction loans, 75, 80, and 85% of cost. But that comes with a price. The price there is they're looking for interest rates north of 8%. So they're really blending a little bit of the cost of debt and the cost of equity there. But yeah, for the most part, construction financing is getting done at the local bank level.
Okay. And getting back to what you were saying about acquisition financing, is the constraint on LTVs the fact that appraisers can't keep up with the galloping market and the increase in values and the compression of cap rates? Like, why aren't higher LTVs being supported? Is it all debt yield, or is there another factor?
It's 100% cash flow, right? People are paying so much for these cash flow streams that there just isn't enough cash flow to get lenders comfortable with the higher LTVs. A lot of the deals that we're seeing when something's trading at a sub 4.5 cap, there's not enough cash flow there when you run the model to get or to comfortably service a 75% loan. So if you're constraining something at a 7.5 debt yield, which is down from 6 months ago, the lowest debt yield we were seeing in the market was at about 8. That has come down to 7.5. When you're constraining it at a 7.5 debt yield, you just can't get to that 65, 70, 75% leverage point. It's really just a function of what people are paying for these cash flow streams.
Got it. Okay. Liz, we're going to come back to you as a consumer of debt products, but I first want to change things up for a minute and ask Aaron what role the easy credit environment pricing of institutional portfolio sales. It must have a huge effect on deal structuring. and I'm curious what you're seeing and what kind of financing vehicles are being used by those that are financing a typical institutional acquisition portfolio of, say, $250 million.
So I think, as you pointed out, David, I mean, our real acumen is portfolios, and largely institutionally driven at one side or the other or both of a transaction, whether it's the buyer or the seller. What we've seen, I think, is that the general capital markets has certainly kind of fed the beast, but that debt itself for the institutional crowd, the core funds, the core plus funds, who in our opinion are really the big driver to at least the large deals that get a lot of the press. They're not very leveraged buyers to begin with, 55%, because I think a lot of their strategy is use an existing credit facility, whether it's a revolver, an act line or something, acquire assets and hold them for 6 months, 9 months, 12 months. I mean, lately, I think that hold duration is shorter than it has been historically, because they get such a huge markup after they get in. Operations kind of continue to get traction, NOI growth, revenue growth that we've seen, has really driven that underlying value. So they'll come into an acquisition at 50 or 55% leverage on some sort of existing debt facility, and it's a floater, sometimes below 1%, most of the time, sub 2%. Hold it while they improve operations, get a leasing season or two under their belt, and they'll do a markup of value. Quite as big an issue, and they'll go do like a SASB or something where they're financing several $100 million at a time, and at that point we'll lever it at 65% or so. But I think a lot of the this cap rate compression that it's not just talked about, it's certainly real, and certainly the transaction volume that the industry is going to see this year, which is probably anywhere from 3 to 4x the 10-year average, and still, probably 2x what the last 3 or 4 year average has been. It's return expectation overall from that capital. Like the core capital just doesn't have the same value add target. They're not trying to hit, a 1.8 or a 2.0 multiple. They're not trying to hit mid to high teens levered IRRs. They're in the, kind of mid single digits on unlevered IRRs, and, high single digits and maybe very low double digit levered IRRs. And that's their capital expectation is set up for that. Their investor base is set up for that. And so I think the lending environment, especially the asset level lending environment, is much more a driver and an indicative data point for one-offs and smaller deals. Call it 50 million and under, which is not a small deal, but smaller compared to a lot of the other stuff going on. So I think there's a bifurcation between what the debt markets drive on some of the smaller stuff and what the debt markets drive for a lot of the larger deals. The larger deals, I think, have just seen massive compression in just general yield expectation, and they're just not using leverage to get there like some of the smaller deals do.
So, Liz, you're the lone consumer of debt products on the panel here. With what Aaron is describing, it's an intensely competitive market. What financing structures are you using in order to compete with the type of money that's willing to accept, levered IRRs in the high single digits or low double digits? That's aggressive pricing.
Well, first of all, we have a core plus fund that's doing, I guess, those types of returns, but that's not our core investment strategy. Most of what we do is more in the mid to high teens and value add, and that's what I've been buying for the last 15 years. And the way we make it work is we, fortunately, it sounds like, have found financing that's willing to go way higher in leverage and way lower in debt yield than what's been described on this call. So we have lines of credit that allow us to go sub 6 debt yield up to 70% LTV. And then we had one prior to that was 75% LTV and like 6.5, 7 debt yield. I think there's no question that debt yield is abysmally low, but the debt service coverage, given where LIBOR is and the spreads are, is over 2x. So people have gotten comfortable, given and myself included, because we're buying these deals at super low cap rates. But we've seen the tick up in revenue and NOI post closing that enables us to feel comfortable that those will grow, and the DSCR coverage is also making me at least comfortable levering them to that extent. But it's honestly the only way to compete right now. We're trying to get teams returns is leverage, and high leverage, really, higher than what you're describing, what has been described. And we do FASB transactions, so we'll buy on a line and aggregate, and then we did a large an off-market deal this summer that we did as a single asset issuance as part of the deal. And then last year we did a refinancing. There was a FASB, and we're in the process of doing another very large refinance that will likely be 75% LTV.
And what kind of debt product are you using for that refi?
CMBS and single issue borrower, which is the most aggressive of the CMBS debt, because they can securitize it and sell it off. And the CMBS lenders like them because they're large loans. I mean, this will be over a $600 million loan, the one we're doing this time. And, the deal we did this summer, I think, was in the 400s. The deal itself is in the 600s. So to Aaron's point, a lot of that is portfolio, driven. Like, we can't get that kind of price. Like, we can't get the same spread and LTV on that type of debt yield on one-off deals, but we can get pretty high leverage on one-off deals in an aggregation vehicle, because the lender is making a trade in their minds. They'll get this CMBS business down the road. And so, they help support our business by buying, by financing alongside of us buying. And then ultimately,
Are you concerned about defeasance on the other end when it comes time to sell?
We do all floaters, and we do all, 2-1-1-1. So we do a 2-year term with a 1-3-1
within the CMBS structure?
Yeah.
That's fantastic.
Oh, it's a good structure. It's working well. Knock on wood. But I mean, I think that's what's driving a lot of the larger groups that are getting into the space right now are using this type of financing to pay what they're paying, because there's for sure a core element to a lot of the deals, but the stuff that I buy and have historically bought, like the stuff that Aaron's selling, is more core. I love Aaron. We've been friends forever. We don't do that many deals together because I buy different types of assets than what he sells typically. Mm-hmm. So I do think, because storage has, I think this is driven by fundamentals, right? Like, storage has had really strong fundamentals. And so I think, I don't think this is like, the financial crisis from before. Again, the coverage is there. And so long as you cap the LIBOR, you're covered, right, for the term of the loan. But I do think we're getting into kind of outrageous pricing levels overall in the space.
Yeah. And Liz, I agree that the fundamentals are a huge driver, but I think the fundamentals have kind of been the magnet for this core capital to come in that we've heard for years, and we've used in pitches for years, that there's all this new capital coming into the space, and that there's more capital than deals, and supply demand econometrics take over, and that drives down pricing. But this last kind of test for the industry and the durability that it showed from March of 2020 kind of through today has, I think, brought in capital that's tried to figure out a way to get in, hasn't been able quantitatively to go into investment committee and say storage is something we should be in because this is what it's going to do for the next 5 years. But you can't argue with how it's performed throughout multiple tests, multiple recessionary tests. And I think that this time around, the capital, because there's more capital than ever looking for yield, not just storage period, there's capital looking for yield everywhere, that you can't ignore the durability of the product type anymore. And the poorest of the poorest capital has found its way into the space. And it's compressed cap rates to the point that to those of us who have been in the business for a while think, this last 150 basis points worth of compression, it happened more rapidly, than any other 150 basis point compression in the past. But when you look at where this core capital has come from, where they've been investing that capital over the last 5 years and the returns that they target, this is still, by comparison, a positive trade. So to veteran storage capital, it looks aggressive, but to the capital that's really driving these returns, there's still meat on the bone.
Yeah, I think you're right that it's the fundamental. I mean, obviously the fundamentals have been really strong. I do think in addition to that, it's kind of like what else? Because office, and retail, I think it's just there's so much capital. And not only did storage perform, well, where else is all this money going to go? Because those other asset classes, which are enormous buildings and values, are sort of shut down for a while in terms of like places to park capital. And I'm very concerned, to be honest, that like it's fine if they're doing a portfolio, but where I have always historically argued or felt is that no one's going to do the work that my team do if returns are the same as buying an office building or a hotel. Because we do, we've looked at 4,700 properties over 4 years and bought 287 and 179 different transactions. And people say small deals are as big as hard deals. They're harder a lot of times because the zoning and the entitlement and some of the stuff we buy doesn't even have a toilet on the property. We got to figure that. It's not easy stuff to do. And so I don't think anyone's doing that. It's not going to get the higher returns. So because just the law of the asset management business, it's not economical to have, such little equity that you can invest. That requires a very large team to do it right. If you're not getting outsized returns. So I don't know. I'd be curious what you guys think. I don't know how this is sustainable, at least on the value add side, if returns go to 10. I wouldn't do this for 10 returns. Yeah. I love it, to be honest. Maybe I would.
I understand. I understand what you're saying. I want to give Anna a chance, but Devin, I think you're on topic here, so take it.
Yeah, I just wanted to, what Liz described, we're putting clients in similar structures, but those are taking more of the form of a CLO structure, where it's really a floating rate loan going into. So it does have characteristics of a CMBS loan, but it truly is a floating rate loan going in. And those are reserved for, $100+ million transactions a lot of times. So I just wanted to clarify that point.
Okay. And I want to take it back to smaller non-institutional transactions that I think you typically do, and get a sense of your typical customer profile and geography of customers. Like, who is the consumer of the SBA lending product?
Yeah, it's very different than what's been previously discussed on the panel. We're talking about a lot of kind of institutional money and institutional buyers. So with small business owners, my typical customer is usually like a husband and wife team. They're probably late 40s, early 50s, thinking about retirement, trying to put their money to work in real estate. So it'll work harder than the returns they're getting in their 401k. They're also looking to, maybe small business ownership has always been a dream of theirs, and they kind of want to lease this up while they downshift their day job and go into small business ownership exclusively as an income source and kind of quit their day job. We lend all over the country. So, we've got customers all across the country, and it tends to cluster just kind of where population centers are, and it makes sense. I'm still waiting on a call for a beautiful Hawaiian self-storage deal, so I can fly out and see it. But mostly
Just for a site visit.
Yeah, that I would love to do that. I'm going to not as exciting places, but it's usually kind of a husband-wife team or someone who they're not working it every day, but they're going to take a pretty active role in the management of the business. Obviously, if they're going to be a small business loan consumer, they need to really treat it like they're running a small business. So it's
And
a
are any
lot
of them
different.
accumulating small portfolios so they come back to you a second and third time?
Oh yeah, I've got a lot of customers that are on their fourth, fifth, sixth loan with me. I've been lending since 2015. I can think of a guy, he picked an area in rural Georgia. He's not even there, but he owns like 85% of all storage inventory within this like 3-county area. So he's able to control pricing in kind of a tertiary market, and the prices that he's getting because he controls the market, is better than a lot of, cities and towns with a higher population base and better demographics, but he can just control the pricing because he controls the inventory.
It sounds like a dream business model.
The small guys are smarter than us, I will say. I'm not surprised they figured that
Well,
out.
their returns are higher.
Their returns are higher, and they're also like, I think it's so funny, a lot of the people entering the space, they think it's going to be a quick, like, oh, we'll outsmart this small little guy who has been in storage forever and making all this money. It's like, I think he's probably smarter than you.
Okay, so now that we all know where we're at, I want to turn the discussion a little bit. So, Aaron, no one has more detailed knowledge of self-storage metrics and market dynamics than you. We all agree that we're living through unprecedented, high-flying times that some of us veterans may never have imagined being possible. So what's next? Where are we going from here as we transition from the COVID economy, which paradoxically has been so good to so many of us? What do you see is coming next down the pike?
I think generally there's just a greater awareness of the product type. I don't know that the data is out there to quantify it, specifically, but there's a greater percentage of the population using storage than there was in February of 2020. And I don't think anybody in the business that observes operations and move in and move out dynamics and fundamentals could argue otherwise. The question is how much more of the population is using it? How much has that created demand that can absorb the development wave that we know will come at some point? But it's the awareness of the product type has made this a more mainstream. I'm not going to call it, it's not comparable to other core asset classes, but we are more mainstream than we've ever been. Operations are proving that for sure. So, what's next, I think, is just, can we keep that maturation growing without, the impact of a pandemic or some other driver that's overall negative but good for us? Can we continue to grow it good for us while, the overall environment remains good for everyone else at the same time? Because there's no doubt that the developers that built in 17 and 18 who were, maybe leasing up physically, but on a rental rate basis were, as Devin's partner put it earlier, crapping their pants. A lot of mistakes were fixed, or a lot of sins were hidden when all of a sudden we basically had 3 years or 3 leasing seasons of absorption in a 10-month period. I think that was okay. Here's your get out of jail free card. All right, industry, go, be good citizens and don't screw it up again. Not to pick on the developers, but, very few developers, I've never really met a developer that didn't want to develop. So they're going to talk themselves into things that maybe they shouldn't. But, we're in it's a new operating environment. The product type, there's more awareness, there's more users, greater percentage of users. I think people have kind of incorporated it into their lives at a level that is tough to get rid of, at least on the margin. So, long term, that's got to be good. But I think it's up to everybody in the industry to not screw it up, because as we saw with what was happening with at least street rates, not achieved rate. I mean, that's all we could spend a whole hour just on achieved rate versus street rate. But with what we saw with the street rate market, which is the greatest, that has the greatest impact on at least development deals or lease up deals. We were in a much different place pre-COVID than post-COVID, and the memories are short.
Mm-hmm. Okay. So when times are this good, everybody running their businesses look out for threats as well as opportunities. And Aaron, I think you kind of addressed that. You see a robust operating environment kind of sustaining what's been going on. But in contrast to that, what threats do you see on the horizon to each of your individual businesses in terms of trends in the marketplace and things that may happen as the papers, as rates start to rise, as strong operating performance could potentially trigger a revived development cycle? What do you see out there that contributes to business anxiety? Why don't we start with you, Devin?
Great. I think Aaron touched on it a little bit. We're our own vices may end up coming to get us. Lenders are acutely aware of new supply and acutely aware of what they're referring to as pandemic rents. Street rents from summer of 2021 are they going to stay consistent? Are they going to level off? Are they going to start to decrease? And so lenders, whether it's a new development or a stabilized property, are really digging into what's in the pipeline, where are rents, what rents are being projected, how fast have rents grown over these last 18 months. And so the fact that values are so high is spurring development of self-storage, and oversupply is in my opinion the main threat, not only to both stabilized and new developments, and the lenders are acutely aware of it.
Anna?
I would tend to agree with what Devin has said. I think that oversupply is a real issue. It's why we require feasibility studies on any new development that we do, just to make sure that the market can, support what they're looking to build. I think something else that concerns me as a lender, as a great percentage of my loans are construction projects, are just the construction cost increases over the last 18 months have been so astronomical. And so, yeah, we do have COVID rents and rents are high, but the cost of construction is increasing at a rate that way outstrips rental rate increases. And so that's been really concerning to me, and people get hung up on steel prices, but I think the cost of labor is something that's really sneakily increasing, and I feel like it's not really being addressed as much in industry publications and industry talk as much as kind of the steel is. But I am worried for customers. Just it's costing so much more to build the exact same facility. People who sat on a project from 2018 are really kicking themselves now, saying I should have just moved forward.
Mm-hmm. Yeah, I think there's a lot of components in construction costs that are all pointing in. It's unfortunate.
Yeah.
Liz?
I think
threats.
I'm concerned about property taxes because a lot of counties are not doing very well, and there's been a lot of articles about how well we're doing. So I can't imagine we're not going to have some issues there. We're seeing some of that. The others is just expectations. I think to the developers being bailed out, there's no question, and they have capital now. They have track records that let them, great money. There's already a lot of flows. I mean, for me, it's very concerning just the expectations that when you do so well through a great wind at your back cycle like that, returns aren't going to be this high forever. And when you have investors, it's about managing expectations. And, we have developers thinking that they can develop and still get these rents. It's all expectations. And I think they're too high right now. And we're at sort of euphoric level where nothing can go wrong in storage. And I think markets are just a collection of people. and people can like freak out, and like it's an easy tide one way or the other. So I'm worried that like, the public REITs don't have very hard comps to beat, right? And they get like low same store numbers relative to expectations, and God forbid it's 10% same store NOI versus 20, and all these people who just got
The next round of deceleration.
Yeah, like they freak out, and unnecessarily so. It's all relative, right? I'm worried about that. I'm worried because I maybe live in New York, and I know how like these guys, these capital flows kind of flow together. Like they're all kind of together, in or out, and I'm worried that there could be a flow out if other sectors start to, on a relative basis, perform, and they don't like what they see in the REITs. Same store numbers. Not that the fundamentals would be horrible, though. I think they'll still be there. It's just a matter of.
Well, I don't think the levels of growth we've seen in key metrics over the last 18 months can be sustained, and
it will be a question of how, like still good.
How is that going to be spun? How is that going to be spun once we're coming out of that? So we have 5 minutes left. There's a question from the audience about the difficulty in obtaining approvals for development, meaning construction loans. And is the focus more on the deal or on the borrower when development loans are being underwritten? Anna, do you guys do development loans, or are you strictly acquisition?
No, we do a lot of development financing. And to answer that question, it's both. We have to look at the project and see that it makes sense. The feasibility study has to be strong. There has to be, if there's other new development in the area, we have to make sure that there's enough room for all new facilities. And then we also look at the sponsor, the guarantor, to see that they're strong as well. I wouldn't do an A+ project with a C- borrower. You've got to have the strength of the borrower that matches the level of the project. So I probably am going to be looking for a lot stronger guarantor if someone's looking to do a $10 million development versus, Joe Schmo building a $2 million boat and RV storage facility in his town. The strength of the guarantor has to be commensurate with the caliber of the project.
Devin, what have you seen?
She hit it on the head. It's both. Both are very important. From the lenders that we're working with that are non-SBA, experience is also very important. Having a track record, having strong financials, having a track record, and having a good project are the three major points that lenders are looking for.
Okay. Okay. So, where do you guys see interest rates relative to now in 12 months? Starting with you, Devin.
I've been saying rates have been going up for about 12 years, and I've been wrong for 12 years. So I would think they're going up if inflation, if there's inflation like people are talking about. I think they've got to be going up. But if I'm betting, I'm going to say they're going to be flat.
Aaron?
Flat.
Anna?
I think they'll be up in the next 12 months. If they don't increase interest rates, I think we're headed for really, really bad inflation. So I think they'll make some kind of correction in the next 12 months.
Liz?
I think flat because I think our country's borrowed too money to afford otherwise.
Say it again.
I think flat because I think our country has borrowed too much money to afford otherwise.
An interesting problem for policymakers.
There's too much capital out there looking for yield that will keep keep in mind interest rates, at least in, where Liz plays, where I play, and even where Anna and Devin play also, a large portion of the interest rate market is driven by the consumer that's getting yield on the debt. So until they can start finding kind of, riskless yield at significantly above where it is now, there's nothing that's going to drive the supply demand equilibrium of interest rates higher. The Fed's just one piece of the puzzle.
You also have a worldwide aging demographic and retirees, right? So like retirees need yield, and there's a huge boomer population retiring. You have Asia, similar.
Yep.
Like, I think that lends itself to yield compression. Unfortunately.
Interest rates are a supply-demand driven pricing product. So the government's one small piece. I don't see anything on the horizon that's going to massively increase where people are looking to get paid. They'd like to get paid more, but there's just no driver to see it increase substantially.
Aaron, I would be remiss if I didn't ask whether or not you think Dusty Baker will ever win a World Series.
That hurts, man. That really hurts. I think he will. I think it's going to be next year.
Well, you certainly have the talent. Jessica Johnson.
David Levenfeld, good to see you. It's been a long time since I've seen you on a Zoom interface like this.
I know.
But I got to talk to you on the phone recently, which has been a pleasure. So
absolutely.
Thank you for moderating today, and thank you everyone for joining. And David, I'll let you close out the session.
Well, I don't think this requires much of a wrap other than to say that we really appreciate your guys' time. And when there's veteran, articulate, active participants in the market, the panel takes care of itself. So it was our pleasure.